Today, my guest is Scott Hollister. Scott is based in Connecticut. He is a former school teacher turned real estate agent, mortgage broker, and investor. And he's also the host of the podcast, The Book Club Interview. We'll talk to him in just a second. But before we do, I just want to remind you, if you like the show, CREPN Radio, we would love to hear from you. Please let us know that you like us. You can like, you can share, and you can subscribe. Also, if you'd like to see how handsome our guests are, you can check out our YouTube channel, and that's under Commercial Real Estate Pro Network. All right. Now it's my pleasure to welcome my guest, Scott Hollister, to CREPN Radio. Scott, how are you doing?
I'm doing well, Darren. Thank you very much for coming out, inviting me on today. I really appreciate it, and grateful for the opportunity.
Well, I'm looking forward to speaking with you. I've heard you on various platforms, and been kind of just we've been exchanging some emails and stuff, and just I'm intrigued about your path, and excited to learn a little bit more about your podcast and that. But before we jump into it, if you could kind of share with the listeners and myself a little bit about your background and maybe what got you interested in real estate.
Yeah, so I graduated college back in 2012 with a degree in health and physical education. Started teaching right away. Got my first paycheck in 2012, and then I knew from that point, to back up a little bit, my parents lost their house during the crash. So I kind of had this sour taste of home ownership. And I knew that if I was to buy something, I'd have to buy something and limit my downside. So what I did was I purchased 2 single-family homes on one lot and rented out one and had a roommate in the other. So I had no mortgage. So I knew if I lost my job, I could at least carry the mortgage and not lose a home. And that kind of was the first taste into real estate. And, I was doing real estate investing all the time, teaching, still enjoying it. Love teaching, but decided to leave in June of 2017 and just kickstart that career. And it was a little bit slow at first, but now that I'm full-time into it, it's been a true blessing, and I couldn't go back to working a W-2 job. So.
Right. Well, and just the, like I said, there is some security. I think a lot of us find the hesitancy to leave that, even though we may not like it or enjoy it. There is this security of that if you show up, you'll get paid kind of a mentality kind of thing. So I applaud you in jumping off the pier there. That's awesome.
Yeah, no, I love that. I think that's the most important thing is I no longer have one source of income. It's like 10, 15, 20, and that's from reading the books and talking to other investors. When you have those multiple income streams, and hopefully you're pushing more towards the passive ones than the active ones, but it again limits the downside.
No, that's awesome. You mentioned you're investing. If you could kind of share a little bit about what you have done with your investing, love to hear it.
Yeah, so I started again, fix and flip. First 2 properties were pretty straightforward. One needed a total rehab, and that was kind of my introduction into construction myself. My father's friend Arnie, who was a professional painter, brought me through the trades, and he really helped me with that first rehab that took probably about 15 days. Nice and light, nothing too heavy. And growing up, my dad was a blue collar worker, so he taught me all the trades. So to date, I've done about 5 rehabs by myself. One was with partners, and that was a full gut on an interior house. So I have the trades of refinishing floors, finished trim work, doing crown, base, doors, kitchens, baths, tiling. And that was kind of, it really helped me budgeting property. So it's mostly been single family rentals. And, in the last year or so, it's been that multifamily 5 units and up. And I think you get to a point where it's really hard to make the single families, especially where we are in the cycle in Connecticut, to cash flow. You start running out of that good 30-year fixed Fannie and Freddie debt. And then you got to turn to a commercial 5/1 ARM set on a 25-year schedule. You're like, multifamily just makes sense. So it's been a growing process, but wouldn't trade that hands-on experience for nothing.
Yeah, no, I would think you're at a distinct advantage, uh, having a real sense of what's needed and how it can be done, as opposed to somebody. Uh, I know when I look at things, I think you have to blow the whole thing up and start all over, kind of thing. And I'm always amazed at how the professional comes in and sees what needs to be fixed and click, click, chop, chop, or whatever. And it's all put back together and hopefully the bill's not what I thought it would be, but, so tell me a little bit on the different ones you've done. So it sounds like you've done some flips. Have you also, are you acquiring a portfolio or what are you doing there?
Yeah. So, it's again, building as many passive income streams as I can. I think the single family still makes sense. There's a better exit than, it just have more buyers in the pool. And depending on, if you're buying right and you're managing right and, you're financing right, I think you can always make a case that a single family is a really good solid rental, especially if it's in a B or A class neighborhood. So that's, still trying to acquire those. My main way to acquire those are MLS REOs. And as I'm sure across the country, those are getting harder and harder to find, especially in Connecticut market. You can still find them, but again, if you can finance it right, I no longer can get that Fannie Freddie debt. So every single family I look at, I have to look at the end financing. And if it makes sense, then it's a purchase. I did one flip once, and this was my revelation. We were doing a flip at the same time I did this other single family rental, but instead of selling it, I was going to pull it out in a cash out refinance. And I made 3 times as much money with the refinance tax free than I did with the flip. So it was kind of this, and I got to keep the asset that was paying me monthly. So I love the buying hold, and I love interviewing investors that have 30, 40 years experience. And most of the times they say their biggest regret is selling XYZ. So I try really hard not to sell anything anymore.
Right. No, I concur. It's, I think I heard it recently, maybe it was Grant Cardone talking about the secret to real estate is to buy and wait, don't wait to buy, kind of thing, and if you do that and you wait over time and excuse me, the equity grows up, you do have that access to that, cash with, non-taxable event kind of things. That's awesome.
No.
So I just want to make sure I understand. So are you doing any multifamily then? Or it sounded like you'd mentioned 5+ units. I didn't know if you were lending on those or if you were buying those.
Yeah. So mostly fix and flip. I always, try to get the value add. I think that's, especially in the beginning of my career where I don't have a lot of equity to keep plunking down 25% on each property. So as far as a lender, the most we've ever done fix and flip capital has been in the 60 units or so. As an investor myself, I'm really looking in that $3 to $5 million range. That equates to like a 25 to 50 unit in Connecticut. Especially if you step out, you can easily go into another market where you can, purchase 100 unit for that same price. So,
Right.
Things are within that range. Jumping up from a single family to that makes sense. Jumping for single family to a 250 unit, it's hard to wrap my head around. So making those small incremental steps going up.
Gotcha. And are you doing this with partners? Are you syndicating, or what's your strategy on the multiples?
Yeah, no, and syndication is definitely a tool in the tool belt to use. It just has to make sense. But, from what I've learned over the last few years in it doesn't solve my problems right now. It gives me a paycheck up front and it gives me a bigger paycheck on the end, hopefully if you perform. And it doesn't solve my monthly cash flow goal, right? And again, that's syndicate, that's deal specific, but the deals I've been looking at, you really try to get that cash on cash return towards your investors. Anything above that right now is typically hard to get. So I've kind of taken a step back and more looking at joint ventures. So And typically this is for more of your friends and family that have capital in their, 401k or Roth. And you say, hey, listen, let's own this asset together. And again, we're going to hold it for a long time. And again, with the syndication, you kind of have to have that sale date to give that IRR. You don't have to necessarily sell, but that's the end goal. And to me, to backtrack again, you try not to sell.
Yeah, no, I hear you loud and clear. I have been similarly, I don't want to say puzzled or confused, but I guess I am from the buy and hold cloth, and that's just kind of where I find myself. Although I get the transactional in out if you have a true value add opportunity, but it seems to me that you're still it's basically like you were talking about flipping. I mean, there is a similar, maybe a little longer hold than I think you said you had your first one was a 15-day flip, but still the idea being that you find an underappreciated asset, you improve it, and then based on market forces, you're able to command a higher price on the exit and reward the investors. So I get that. All right, well, let's talk a little bit more about your podcast, because I'm curious to know about and not just your podcast, but the books. Obviously, your podcast. Let me see. Make sure I get the name right. It's the Book Club Review or Interview, correct?
Book Club Interview. Yep.
Okay. And so I'm assuming you're a teacher. B, you have a podcast about books. You read a lot. Is that fair? So
Yeah.
The background behind you suggests the same as well. So, so let me ask you this. So are there some go-to books that that for investing that resonated with you prior to getting started in real estate?
Yeah, and that's I'm true education is my core, and I think as investors, one of my strongest suits is being able to either read a book or have a conversation and fast forward and then retrack. So I can sit down with someone that has 30, 40 years experience and ask the right questions. What would you do differently? What were you successful at? And knowing what you know now, would you change anything if you were to, put yourself in my shoes? And from that, just books in general, right? Where typically whoever writes a book has a lot of experience, and we're going to get all that experience for the price of $15-$20. I tell people, I hope no one ever figures out the true value of books, because the price is just going to skyrocket. So I think there's probably about 10 to 15 good commercial real estate books I've read in the past couple of years that, have really jumped out the page. The first two books that really resonated with me were Jay Scott's books. So the book on flipping houses and the book on estimating rehab costs. And that really helped me from a sequential standpoint of looking at a property and going A to Z, everything in a house, what it typically costs, so I can not only, perform a rehab, but perform it in the right way and try to bypass all the mistakes. So those books lay the groundwork for my real estate investing career, because I had the contracting background, doing fixing here and there, but not really the, mind behind a business of it. So those helped a lot. In terms of commercial real estate books that I read in the beginning that just helped me really get a good overall picture were David Lindahl's books. He has Commercial Real Estate Investing 101, Multifamily Millions, and Emerging Real Estate Markets. Those three books I think are a very, very good introductory course. If they're like your 101, 102s, kind of lay the groundwork and really figure things out. And I think two books that I think were mistitled were written by, I'm trying to think his name right now, Ken McElroy with the Rich Dad Poor Dad series. His ABCs of real estate and management. I think it from what I remember, it was, here's single family, here's a 2 family, here's a 3 family, but as you scale up, here's what really makes sense is having 25, 50 doors under one roof. And here's why. Those were another good introductory course. Now, if you're trying to get into that second level of, negotiating, Jay Scott has another good negotiation book that I really like. Joe Fairless just came out with the best ever apartment syndication book, which I thought was extremely detailed, 400 pages of packed syndication knowledge where you're really not going to get from anywhere else. Gene Trowbridge has the Whole New Business book, which really teaches that, syndication model, really detailed oriented. And again, there's a few other ones, Managing Rental Properties by Brandon Turner and his wife. That was a phenomenal book from really understanding, how to manage a property. And I kind of recommend new investors always do that for that first year or two. That it's kind of like the same with the construction, having the hands-on knowledge of it. When you hire it out, you're just going to be that much better to really have those conversations. And I'd say there's a banking book that I read this year, and I read a book a week last year, for the podcast interview, and I was interviewing one person a week as well. So someone recommended this book, The Banker's Code by George Antone. And he's written 3 books. I just went to one of his seminars out in California 2 months ago. Very, very intellectual and smart guy. And he starts the story of Monopoly. He's, what's the best place to be in Monopoly? Is it, buying the house, trading it for the hotels? He's like, no. Is it buying Boardwalk and Park Place? He's like, no. He's like, it's the bank. He's like, because the bank sets the rules and the investors have to play by the rules. So that blew my mind. So that's kind of why I'm really trying to understand the financial, industry a little bit better and becoming a direct lender. I think that's a really good way to keep your capital, I'd say, the velocity of it, being able to put something in and getting it out in 6 months, whereas getting in and out of a larger real estate deal is not that easy. So I think I've found that the true buy and hold rentals and fix and flip capital, secured by an asset are hands down probably 2 of the best ways to grow a real estate business.
Yeah, you're mentioning of that the banker's code. I'm curious to read that. My dad was a career banker, and I never really understood what he did till I went to go borrow money. And but I do agree with you in that just that notion of the bankers make the money. I've got one client calls them the banksters. The kind of the mentality or the sense of it's always kind of you playing by their rules. But even I was just kind of curious, in your lending, do you work with, do you raise capital to lend? Is that one of the things you do as well?
Yeah. So it's, at first I don't, so there's multiple ways, and just backing track this last year. So my mother was in banking for 30 years, and for the first 20 or so, it was residential lending. And she kind of taught me those. I heard it over the years, certain tidbits, and in the last 7, she's been in hard money. So fix and flip, high interest, short terms, it's secured by the asset, but needs a good rehab budget. In the last, probably rewind 3 years ago, I started brokering. So really understanding the deals, putting the capital and the investor together, collecting a fee at close. And then last year I started direct lending. So, I'm on the beginning of my career. I definitely don't have that line of credit or that much capital to throw $100K out per deal and let it sit for 6 to 12 months. So I've lined myself with either private individuals or banks that want to table fund. So I put up the first 10, 25%. They come in with the next. I get to underwrite the deal, go through the approval process, manage the construction draws, and do everything else just like a lender would, but not putting as much, skin in the game. The downfall is if anything were to happen, I lose my investment first. But again, that comes from really being able to work with investors that I trust and know that are going to get the deal done. And I'm also an investor myself. So if I see the projects, I can tell from photos and a scope of work and, the ARV and looking at comps that, okay, we've got a good deal, we got a bad deal. So I really wanted to understand that. And that's kind of my entry into getting to, being my own bank down the road.
No, I love it. It's again, it's kind of one of these experiences of, understanding who's really in control and where the money's really made, and taking a view at it from the bank side, and then saying, wait a minute, that you can lend money, and private lending, and just all of the different ways to make money in real estate.
Mm.
It's fascinating. Want to ask you a little bit about your podcast.
Yep.
Tell me a little bit about what kind of the format, and maybe a recent book or author that you've interviewed.
Yeah, so the format is typically 45 minutes to an hour. We, talk about the author's book, a little bit about their background, and I kind of I read the book and I divide up the chapters into the main points, and then we kind of discuss those main points to really dive in deeper to the topics. Kind of a light scrub through first, and then whatever that needs clearing up. If I have any friends, I'm like, hey, I'm interviewing this author. You have any questions after reading that book? Just let me know. We'll try to fit it in. So it's kind of, going back to the classroom. We can read a book, but having a really good teacher there to talk about those main topics and clarify them just hits that knowledge home a little bit better. And it's been phenomenal. I get to, spend an hour with some amazing authors, and it's been a blessing. So.
Yeah, I'm just kind of curious. Is there anybody that you've interviewed recently that spoke to you, or a book or an author you enjoyed?
Yeah, so I got to, interview, George Antone with the Banker's Code, and that was a phenomenal one. I'd probably say a couple of my favorites are Getting Things Done, and these are books that truly were, transformational for me. So David Allen wrote, the business book of the 2000s, as Time Magazine called it, and Getting Things Done, and that really helped clean up my life. So, getting a filing cabinet, making sure that anything that comes in the inbox, and you have a place for it so you can work efficiently. And that book changed my life from a management standpoint. The other one that changed my life from a focus standpoint was The One Thing with Gary Keller and Jay Papasan. And got to talk with Jay for about an hour, and that was just, it blew my mind, because that book, I just remember reading it before work. And I'm an early riser. I get up 4 or 5 a.m. and I like to read for about an hour before going to the gym. And I just remember reading those pages and being like, this is so simple, but I get it. It helped me clarify what was in my head. So if I had the management, the focus, and now it's just learning the 101, the 102 to apply the knowledge. So.
No, I love that. And I love the kind of the width of topics and stuff. I think so many times when people think real estate, the what was the Kawasaki Rich Dad Poor Dad's the one that everybody points to, and I think there's so many good books on topics that are intricate or more detail oriented on just the nuances of real estate, and just I applaud you to get into all these different just different topics and different flavors there, and explore that, and then with your background as a teacher, to be able to, like you said, go through it and then have the author. I'm sure your guests really appreciate the opportunity to speak with somebody that's read the book and has a kind of an educator background. I'm certain that's a welcome interview. I want to ask you, is there a recent lesson that maybe you read about in a book that maybe it wasn't clear when you read it, that later you had an experience and you thought, that's what they meant?
I think the first one that comes to mind is definitely George Antone, and he wrote another book called The Debt Millionaire, and he invited me out to his event in California. I brought my friend Andy with me, and we had a conversation, and I read it in the book, and he said, the asset doesn't make you wealthy, it's the underlying capital stack. And at first, and that's why I like books that challenge my thinking and my belief system, because I'm younger into my career. I've only been through the upside of one cycle, so I don't know any of the down cycles, and I'm really trying to be that solid investor that's going to be there for the next 30, 40, 50 years. So I like challenging my own way through books and other authors, because I may not be doing it right. Someone may say, "Hey, single family rentals aren't the way. Multifamily investing isn't the right way. It's lending, or it's this," and that really blew my mind. Is how you know put the capital on the deal more up, and then the deal itself. So they obviously both matter, but it's how you really structure that capital that's going to make you wealthy long term.
Right. When you say it, I'm thinking, is that kind of the when I say, well, let me kind of phrase this. So when you say that, I'm thinking of, historically, I've always thought of just, you get the one loan kind of thing, and it's got an amortization, uh, 25, 30 years or whatever, and fixed rate kind of thing. But as I see these more complicated deals, these larger deals, I recognize how important like the interest only is, in the beginning, to, improve your cash flow in the beginning so that you can, um, bring the rents up, and
Mhm.
you know, make the asset perform better before you actually start, attacking the principal. Is that kind of along the lines of what you, or what you thought that he meant, or did you get a chance to talk to him about that a little bit?
Yeah, and I did, and I think that's again, you have to really understand capital, and that's why I like understanding, is because it's all deal specific, market specific. But let's say you did 3 years interest only. In cash now is obviously better than cash in the future. So you can reinvest that capital and keep it growing, especially if you have some capex or rehab that you really want to put back to increase that rent so your NOI gets boosted. That's another great topic. But for me, obviously, you know, trying to go out 10 years and look at an exit of a property, no one knows. You can put an exit cap rate at this, but truly no one knows what the market's going to do. So as a personal investor, I've always looked at long-term fixed debt if you can get it, no balloon payment. But if you do have a balloon, hopefully it's out far enough where you can at least get through a cycle, historically speaking. eh, You know, um, but again, I think what he was talking was, he comes from a standpoint of looking at the last crash and what happened, and instead of putting debt, do more of like an equity split. And not only doing that is because if you have all debt and 100% finance, if you have one hiccup, you're probably going to get burnt. But if you have equity and you're sharing in the partnership, you have that capital kind of weigh down those risks. And also, I remember him talking about having enough cash reserves, and he has a certain ratio of his portfolio, and he talks about a certain debt range that he likes to keep everything on, depending on where he is in the cycle. So I think knowing those, I wouldn't call them rules, but rules of thumb, and really taking a look, let's just say that, my vacancy dropped from 100% to 90%. Can I weather the storm? Let's say if I have to offer rent concessions in year three, how does that capital look? And is that interest only going to go to interest and principal? And is that going to bury me? Kind of looking forward down the road a little bit.
No, I appreciate you sharing with, a little bit about that, because, I've got a new book I'm going to put on my must read list. That's great.
Mhm.
Hey, I want to shift gears here a little bit.
Mhm.
My background is I'm an insurance broker, by day, and we focus on risk management. And I've been trying to identify a question I could ask my guests, about risk. And essentially, in risk management, there's three basic concepts. You can avoid risk, which is, for instance, you don't do the deal. You can minimize risk, and like whether it be like with, we were just talking about the money there, you could bring on an equity partner, or you could transfer the risk. And a lot of times that's kind of what the insurance, side of things are. Uh, I want to start asking my guest, and you're my first to get this question, so I appreciate you your willingness, or hopefully you'll be able to answer this. Um, I want to ask you, what is the biggest risk you face? And I'm assuming this would apply to investing as opposed to books in your podcast. Um, and then from that, can you share with us what you are doing about it?
Yeah, I think the biggest risk on a smaller scale, obviously with rental properties, is tenants, slips and falls. Being up here in New England, we have the wintry mix that could just cause havoc on everything. The way you know, obviously from an insurance standpoint, I've always been at the school of thought is to be properly insured, getting a good insurance broker that really understands investing in properties that you can work with, that's going to pick up the phone when you call and is going to respond to your emails. And getting the right umbrella policy to make sure that if something happens, because it's going to happen, accidents happen. You just got to make sure that, again, that you're properly covered and you're doing everything that you can to, the same thing with you shifting the risk. It's the same thing with the bank. It's putting the risk on the investor. They're taking the risk. So as a single family standpoint right now, I'm pretty lucky with tenants that they do their own lawn, snow and lawn care right now. I've shifted, that in the lease that says, you're responsible for this. Again, I think one of the horror stories that I've heard was there's a local investor with some small multifamily. And again, this is like more of the mom and pop mindset that, I'm going to do the snow removal. I'm going to save $10,000-$15,000 a year. I'll get the plow truck. Well, yeah, he saved that, but he did it for 30 years. And in year 25, he got sued for $70,000 and they won. So you backtrack your savings for that many years. And again, you're getting another job if you're doing the management yourself. So hire it out, make sure they're properly insured, make sure you're properly insured. And that's my takeaway. I'm not the best to ask when it comes to insurance questions.
Well, and again, I want to be clear on this as far as the risk. I mean, like I said, I'm an insurance, and I appreciate you answering it from an insurance standpoint. But even as a broader question of risk, I think you identified your tenants as being a risk point. But I look at vacancies as being a risk point. Could be the market, interest rates going up. There's the whole plethora of risk, and I appreciate you identifying it with the insurance for this. But that's kind of more the in the broader spectrum. I think we all identify risk on a daily basis. Whether you're driving down the street or you're going out to eat or whatever the case may be. But as you're plotting your investment strategy, I think there's all sorts of risk that we're mitigating, whether it be making certain that you've got you've checked your numbers twice before you go to the lender. You've gotten multiple bids if there's some sort of a repair that you're going to have done or something like that. And so I think that in the broader picture, that's kind of more the mindset of how do you approach that and stuff. But anyway, I appreciate you again being my first to answer the question, to approach it from an insurance standpoint. So I appreciate that.
Yeah. And from an investor and rehab standpoint, the two biggest issues that people get hung up on are underestimating the rehab cost and underestimating the time to complete the project. And you'll find that if you go for that type of lending, they're always going to ask, what's your exit strategy? What's your backup exit strategy? What's your third exit strategy? And that's what I try to find. Okay, if I can't refinance out, can I quick sale? Can I fire sale it? Can I do some type of creating strategy? Okay, what does it look like on a commercial note? What does it look like on a fixed 30-year, Fannie and Freddie note? So, and, I try to play out that worst case scenario. Okay, can I weather that storm? And then back into the deal.
Right, right. No, I totally employ your worst case scenario strategy. I find it works well for me from the standpoint if you know you can survive that, everything else is kind of gravy, kind of
Mhm.
thing. So I love it. Scott, I want to ask you before we wrap up here, where can the listeners go if they'd like to connect and or learn more about you?
Yeah, so we have a Facebook page, the majority for the book club interview. You can look that up. I'm on Facebook as well. I really spend my time mostly on the Bigger Pockets forums. They're a great resource for investors and people looking to network and learn a little bit more. And I also, our website is davidwesleyrealestate.com. And that, comes from a history of, so I named my company after my father, Dave Wesley. So that's kind of the background of that. And no, I appreciate in coming on the show, and thank you very much for your time, and looking forward to continuing our relationship. And I appreciate your recommendation. That's how we got connected. I think you introduced Doug and for the book club interview, and appreciate that as well.
Yeah, no, I know he enjoyed it, and glad it worked out for you there. So thanks for doing that, and thanks for coming on. I've enjoyed it immensely and learned a lot, and look forward to doing it again soon.
Sounds good.
All right. Hey, for our listeners, if you liked this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.